Well, in a day that turns very ugly very fast, as I said at the top of the show, it's worth focusing on the kind of high-quality stocks that you can confidently buy into any market-wide weakness. Take Cisco, the networking equipment colossus that's in the process of pivoting toward a host of faster-growing end markets like the Internet of Things, cybersecurity, proprietary software, and the data center. Here's a classic tech value stock, one that trades at around 12 times next year's earnings, big discount to the S&P 500, bountiful 3.3% dividend yield. But what really makes me like Cisco, the reason why we own it for my charitable trust, which you can follow along at actionalertsplus.com, is because the company's efforts to get itself back into the growth mode, they seem to be working. The last time Cisco reported a month and a half ago, they posted a 3-cent earnings beat off a 60-cent basis, slightly higher than expected revenues and expanded gross margins. At the same time, though, management forecast for the next quarter it was a bit more conservative than some of the analysts have been looking for, but that's okay. On the other hand, they also announced a $700 million cost-saving initiative. The company's eliminating 7% of its workforce, and they plan to reinvest that money into their faster-growing divisions. And last week, there was even some chatter that Cisco might be interested in buying Imperva. That's a $1.7 billion cybersecurity company. Obviously, can't talk about who they might buy, but we can talk about that area. Now, Cisco's stock has rallied more than 15% for the year. Did a pretty good job of hanging in there today, but I bet there's more room to run. So let's take a closer look with Chuck Robbins, the CEO of Cisco, to find out more about how his company's doing, where it's headed. Mr. Robbins, welcome back to Mad Money.
Hey,
Thank
Jim.
you, Chuck. Have a seat.
Hey, thanks. Good to be here.
Well, look, we see you in person, so I've got to just do a little bit more of an introduction than I usually do. We know John Chambers for many years, and now you've been running Cisco for a while. And just tell people the difference between this Cisco, which is a great Cisco, and the previous Cisco, which is a great Cisco.
Well, I think that, Jim, first of all, it's great to be here. As I think about what's important for us going forward is, first of all, the industry and everything about the environment in which we operate is moving faster than it ever has, which is going to require us to move more rapidly than we ever have. Right. It requires us to embrace more technology transitions at one time than we've had to do in the past. And we have a tremendous focus not only on taking advantage of these transitions, but also transitioning our own business to what you talked about with IoT, with software, cloud, security. And I think we're just going to have to do it faster than we ever have.
Well, now everyone from a previous year knew that you were in switches and routers. Not that they necessarily knew what those were, but let's call them hardware. Now we think of you as cybersecurity. We think of you as the backbone of the Internet of Things, not necessarily of the Internet, although you're still very powerful in the Internet. Mm-hmm. And we think of you as a company that is got a different kind of revenue stream. You've got something called deferred revenue now. So right. You may be doing better than you look.
Well, as we look to the future, first of all, our customers want to consume our technology differently than how they have in the past. They want to buy it as a service, right? They want to buy things from the cloud. They want to buy collaboration as a service, security services. And we also want to transition our business to be more predictable. So our investors would like to see more recurring revenue, more predictability in our revenue flow. So it actually is great because both of those two things actually align. Now, there's a transition we go through. As we bring out new offers that are more as a service, they end up going into deferred revenue. But over time, that will provide us with a much better business model, and it's the way our customers want to buy from us.
The reason I pointed it out like that is because you have really boosted the dividend. Something you did, it was kind of like a flag that you planted. And it may look like, without people understanding deferred revenue, that maybe that was a risky thing. But you've got plenty of cash, and that dividend could actually go higher over time.
Well, from a capital perspective, we're sticking to our commitment to deliver over 50% of our free cash flow back. Mm-hmm. And we did raise the dividend pretty significantly this last year. And we also have leveraged our balance sheet to actually expand our capabilities through acquisitions in the security space and the cloud space. And if you look at the companies we bought, every one of them has aligned against this business model transition. Or towards a new growth area that's important to us in the future.
Well, I mean, we have the rumors of Imperva. I know you can't comment on rumors, but the idea of putting more money in cybersecurity is something you believe in.
Absolutely. I mean, last quarter, our security business grew significantly. Our deferred revenue within security grew significantly. Mm-hmm. We announced a new next-generation product in the firewall space, and we added 6,000 new customers to that platform last quarter alone. And so as the Internet of Things takes off, and as enterprises become more distributed, there's no perimeter to defend. So what the network, which is where our core is, has to play a much more important role in defending these enterprises. And so you mentioned our core technology, and I think over the next year to 2 years, one of the key differentiators we have is integrating security deeply into those routers and switches, which is what our customers like.
Not putting them on top of it.
In both cases, actually.
Okay, now look, last week we had Yahoo with a big hit, but we also saw, unfortunately, there was a piece, big security bug affects hundreds of thousands of Cisco devices. And I mean, is it just nobody immune, or is this something that obviously it's not the luck of the draw? I mean, how does it work?
Well, anytime you're in the technology arena, you're going to have vulnerabilities, you're going to have software issues, and it's how you deal with those that's most important. And so we released a patch. I think one of the issues is one that we'd known about for a while and had released patches on. And what we expect, how we expect to operate with our customers is that when they find vulnerabilities, they report them to us, and then when we have patches, we release those. Right. It's irresponsible to release information about a vulnerability before you have a patch, right, because then the hackers know where the problems are. Right. So it's part of how we operate, and obviously the threat surface is expanding every day. Right. And we're in a very good position to lead in this market. Okay, now talk about the world. You just did a big deal in Mexico, but Europe's been good. China, where are the areas that Cisco, which always does great geographic breakdown, are doing well? Yeah. Well, we've seen strong performance over the last, say, year in a few countries in particular. India has been incredibly strong for us. The U.S. has been very steady for us. Mm-hmm. Mexico has been pretty strong, although last quarter it was a little weaker. We talked about it. Right. China, we had 3 quarters of growth in a row, and then we had a little bit of weakness in the last quarter. We'll see how that plays out in the future. And then we've got, Brazil's been obviously an issue relative to the geopolitical dynamics, Russia, et cetera. We saw good growth in Australia, good growth in Japan. So I think that the thing we deal with is that all the dynamics, the technology transitions are tough enough. Right. And then the uncertainty in the economy that exists, the geopolitical dynamics, all of those come into play as we look at our business around the world. Well, Chuck, just where is Cisco versus, say, where it was? Law of large numbers, 10 to 15%, 20% growth days behind you. But 5, 6, 7% within reason when all these things play out? Well, I certainly believe that we can grow faster than we're growing right now. Now you said that. You've been very tough on yourself in the conference. I have, and I expect that we should continue to improve our execution in general. We should always be getting better at our own core execution. I think that as we look at the core products, as we drive analytics out of the network and drive security deeply into the network, I think that business, we have the opportunity to strengthen it. Our security business obviously been doing well, collaboration's been doing well. And then as IoT begins to accelerate, the Jasper acquisition gave us the largest commercial IoT platform in the world. And so I think there's a lot of positive areas for us. Now, I interviewed Meg Whitman recently, and she was saying, listen, our business is really starting to carve up Cisco's business. And I said, the enterprise business. And I said, well, Chuck isn't here to say anything, but how are you guys are going at it, and they're getting some wins. Yeah. How do you respond? Well, look, in any given quarter, there are competitors who might gain share. We have competitors that in some cases will get ahead of us in a certain area. Our history would suggest that we actually catch them and leapfrog them. Mm-hmm. And, we're pretty confident in where we are. We're confident in the architectural value of what we do for our customers. And I'm very confident that in the long run, we will win. Okay, you've got $66 billion in cash, a lot of it overseas. How do you get it back here, and what would you do with it if you had it? Well, we clearly are continuing to remain committed to our capital strategy that we've talked about. The dividend is obviously very attractive. We've continued to be acquisitive over the last 12 months. And, we firmly believe, we've been very vocal about it, that we need, international tax reform so that companies can repatriate those funds so that we can make investments here. And, I'm optimistic that perhaps in 2017 we can get something done, and that'll give us the option of using it in any ways that we've talked about. Last question. In the old days, we used to say, wow, one of these big telco companies places a big order with Cisco. Cisco's stocks jumped. Are those days just gone? Well, I think that we still have big orders, but we have a big revenue line as well. So I think that the Internet of Things and this digital transformation that's occurring, there's only 18 billion devices and people connected to the internet today, and it's going to 50 billion in the next 4 years, and it may go to 200 billion to 300 billion. And the more things are connected, the more security is required, the more value we help bring our customers. So I think there's a bright future ahead.
All right, I agree with you. You know that from my Charitable Trust. I think the stock is so cheap of these big technology companies. It's probably the cheapest I follow. That's Chuck Robbins, CEO of Cisco. Mad Money is back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.